Okay, dear students, welcome to your ACCA Tax Pre-Scene Mock September 2025 attempt. We'll be discussing today, inshallah, Section A and B of this Pre-Scene Mock. And Section C will be discussing coming week, same Friday, coming week timing, everything will be same. So let's start. I'm myself, Abil Ahmed, and CEO and principal of Abil School of Accountancy. So let's start from a very first question of Section A. What is junior's total income tax liability for the tax year 24-25? Okay. Junior received the following income for the tax year 2024-25. Property income is a non-saving income. Building society interest, of course, saving income, and dividend is dividend income. So we are required to calculate income tax liability. So we'll make 3 columns, in fact, 4. Non-saving, then saving income, dividend income, and let's make 1 for the total. Of course, property income is a non-saving income, 17,250. Building society interest is saving income, and 16,000 is the dividend income. Let me use the calculator. 17,250 plus 18,000 plus 16,000. Students, I'm getting 51,250. Personal allowance. The sequence of utilizing the personal allowance is, first, you will deduct the personal allowance from non-saving income. 12,570. 12,570. Okay. After deducting this 12,570, you will get taxable income. 17,250 minus 12,570. I'm getting 4,680. Of course, 18,000 and definitely 16,000. Let 4,680 plus 18,000 plus 16. 38,680. Of course, we have to first apply the income tax rate on non-saving. 4,680 definitely falls in basic rate band. Non-saving 4,680 into 20%. 4,680 into 20%, I'm getting 936. Now, please listen carefully. Look at the taxable amount in the column of non-saving. It is 4,680. It is less than 5,000 pounds. As it is less than 5,000 pounds, it means there is a space in the starting rate band. For saving income, we do have a starting rate band where applicable income tax rate is 0%. But out of 5,000, logically 4,680 is consumed by the non-saving income. So let's see how much space is left for the starting rate band. 5,000. 5,000 minus 4,680. So we still have a space in the starting rate band, 320. Starting rate band, of course, saving income. 320 into 0% is obviously 0. Now, we have to check individuals' tax paying status by looking at taxable income 38,680, which is more than 37,700. We can easily decide this individual is a higher rate taxpayer. And higher rate taxpayers, they get nil rate band for the saving income 500. So saving nil rate band 500. Why 500? Because this individual is a higher rate taxpayer. How did we know it is this individual is a higher rate taxpayer? Because if you look at the last column, taxable income total, which is 38,680, which is more than basic rate band limit, which is 37,700. So obviously this individual is a higher rate taxpayer because 38680 is not exceeding 125, 140. We know that if individual is an additional rate taxpayer, then does not get any nil rate band for the saving income. But this individual is a higher rate taxpayer. So out of 18,000, 320 we have taken in starting rate band, 500 we have taken nil rate band. So how much is left? From 18,000, we'll deduct 320, 500. So 18,000 minus 320 minus 500. I'm getting 17,180 on this saving income. 17,180, of course, falls in basic rate band. Applicable rate is 20%. 3436. Now, dividend income. Can I say in case of dividend income, every individual gets nil rate band of £500 irrespective of their tax paying status. So dividend nil rate band is £500 into 0% is obviously 0. Now we have to check how much space is left in the basic rate band. Basic rate band ends at 37,700. Out of that, we have utilized 4680. Logically, we have also utilized the saving income 1800. We have also utilized 500 in the dividend nil rate band. 37,700 minus 4680 minus 18,000 minus 500. I'm getting 14,500. So still we have a space in the basic rate band. So dividend income 14,520, basic rate band, applicable rate is 8.75%, and these tax rate will be given to you in exam as well. I'm getting 1270.5, make it 1271. Let's recheck so that we should not be making any arithmetic error. Perfect. Now, the entire taxable income is 38,680. Out of this, 37,700 we have dealt. Whatever is left obviously falls in higher rate band. 38680 minus 37,700. I'm getting 980. Dividend income 980. Applicable rate is 33.75%. I'm getting 330.75, make it 331. Recheck also so that again there shouldn't be any arithmetic error. So let's add all of them. 936 plus 3436 plus 1271 plus 331. Students, I'm getting 5974. Let's see. 5974. Charlie, but I would consider this question a very good question. Seriously, in a very small data, examiner, they have tried their level best to cover number of rules. Okay. What is the total taxable benefit for Peter in respect of laptop for the tax year 24-25? Peter is employed by Buffalo PLC. He was provided with a laptop for private use on 6 October 2023. It means from here, if I go till 5 October 24, there are 6 months. It means this laptop was used 6 months in the previous tax year. But they're not asking the taxable benefit in the tax year 23-24. They're asking us what is the taxable benefit in the tax year 24-25. Okay. The market value of the laptop when first provided to an employee for private use was 3,800. Basically, other than car, accommodation, and first mobile phone, any other asset is given to an employee for their private use, personal use. Simply the benefit is 20% off the market value when it was first provided to an employee. And the laptop had a market value 2200 when first provided to Peter. Actually, when it was provided to Peter at that time, market value was 2200, but that is irrelevant because the rule says 20% of the market value when it was given to an employee first time, no matter it's a different employee and you are working for a different employee. So, but the main rule is 20% of the market value when it was given to the first employee. So for us, the relevant is 3,800. For private use, Buffalo gave the laptop to Peter on a last day when it had a market value of 1,200. Logically, in the tax year 24-25, there will be two taxable benefit. One, the benefit of use. The second is gift benefit. So let's calculate tax year 2024-25. Use benefit for the entire tax year, of course, 3,800 into 20%. 3,800 to 20%, I'm getting 760. In addition to this, there's a gift benefit also. How to calculate gift benefit? Gift benefit is actually higher of number one, market value when first provided to an employee. At that time, it was 3,800. So Peter, in 2023-24, Peter has used this for how many months? 6 months. So we'll deduct the 6-month benefit. In the tax year 24-25, Peter has utilized the entire tax year. Entire tax year is 760. So half of that. So simply 3,800 minus 3,800 minus 380 minus 760. I'm getting 2,660. This 2,660, we have to compare this with the market value when it was gifted. Market value when given as gift. Given as gift. When this laptop was given to Peter, at that time, the market value was 1,200. So whichever is higher, that is your gift benefit. So 2,660. So it means in the tax year 2024-25, your total taxable benefit is 760 plus 2,660. It becomes 3,420. So taxable benefit in the tax year 24-25 relating to this laptop is 3,420. How much employee class 1 NIC is Mary required to pay for the tax year 24-25? First of all, student, you need to know one thing. Class 1 NIC is actually paid on cash benefit. What comes in cash benefit? Of course, the salary. Second, the bonus. Third, if your employer has reimbursed you, your employer has reimbursed you because you have used your own car for the employment purposes. In that case, if employer reimburses you more than 45 pence per mile, so any amount which is over and above 45 pence per mile, that is considered as a cash benefit. And on that, you have to pay the class 1 NIC. Of course, right now you're working for employee. Employer also pays class 1 employer NIC on cash benefit. So what comes in cash benefit? Salary plus bonus plus reimbursement amount which is over and above 45 pence per mile. So salary is straightforward. 75,000, of course, a cash benefit. She makes contribution 5,000 into occupant. That has nothing to do. We know that. Okay, question. Yeah, it will be uploaded. This will be uploaded, but the coming Friday class will not be uploaded. So this class will be uploaded on the YouTube. Okay, she makes a contribution of 5,000. We know that when employee contributes into occupational pension plan, it reduces the employment income. But actually, for class 1 NIC calculation, it will not reduce your cash benefit. In the tax year 24-25, she drove 14,000 miles in her own car, for which, look at this, Counter Limited paid her 50 pence per mile, which is over and above, 5 pence is over and above 45 pence. So here comes also the cash benefit. Logically, 50 pence minus 45 pence into 14,000. So let's see. Let me write like this so that you should not be having any issue. 0.5 minus 0.45 into 14,000. 0.5 and this multiply by 14,000. I'm getting 700. 75,700 is your cash benefit. 50,270 minus 12,570 rate is 8%. And cash benefit, which is over and above 50,270 applicable NIC rate class 1 employees, 2%. And these rates and limits will be given to you in exam. 75,700 minus 50,270. And I'll be using 2%. 50,270 minus 12,570 into 8%. 3016. 75,700 minus 50,270. I'm getting 2%. 509. 3016 plus 509. So class 1. Employee NIC. So you have to write in the box. 3525. What is the taxable benefit for Geordie in the tax year 24-25? Taxable benefit Geordie, okay. Geordie is provided with accommodation by her employer, which the employer purchased 35 years ago at a cost of 74,500. The property has an annual value 2,600. Market value is this. When first made available to Jody 8 years ago, Jody pays 250 per month to her employer to live in the property. The accommodation does not qualify as a job-related accommodation. Number one, it is not treated as an expensive accommodation. Why it is not treated as an expensive accommodation? Because the cost of the property is not exceeding 75,000 pounds. So cost is not exceeding 75,000 pounds. That is why there will be no additional benefit. So only will take annual value, which is 2,600. But story does not end here. What is happening? Jody is paying 250 per month to her employer. When employee pays to the employer due to usage of the property by that employee, then that payment actually reduces the cash benefit. That contribution actually reduces the taxable benefit. So Jody's contribution will reduce the taxable benefit. Let's see. Payment to employer. It is 250 into 12. Wow. So employer looks very, I would say, wise. Logically, there's no taxable benefit. There's no such thing, loss. Your payment can make your taxable benefit zero. Your payment cannot make your taxable benefit result in a loss or something like that. So logically, Jody is not having any taxable benefit because Jody pays to the employer even more than the annual value, rent value of the accommodation. What are the maximum capital allowances that Blue Cheese Limited could claim in the tax year 31st March 2025? What are the maximum capital allowances that Blue Cheese Limited could claim in the year ended 31st March 2025? During the March 25, Blue Cheese Limited purchased a second-hand machine. Can I say on this machine they will get AIA, annual investment allowance? The old machine was disposed during May 2024 for £10,000. The old machine originally cost £90,000 and the super deduction was claimed when it was purchased. Stop. When you are selling an asset against which previously you have claimed the super deduction, then according to HMRC, entire sale proceed results in balancing charge. And balancing charge actually reduces your capital allowances. Repeat, entire 10,000 is your balancing charge. Let me repeat. If you are selling the asset against which previously you have taken the super deduction, then the rule says entire disposal proceed is actually going to result in balancing charge. And we know that balancing charge actually reduces your capital allowance. On 1st April, Blue Limited had tax written down value brought forward in the main pool is 43,000. So we have got main pool. Tax written down value brought forward 43,000. One column of the allowances. We bought machine 1 lakh that qualifies for AIA. So you will get 1 lakh allowance. Now we sold a machine against which previously we have taken the super deduction. So entire 10,000 becomes your balancing charge. So directly I'm writing balancing charge 10,000. Balancing charge will reduce your capital loss. On main pool, we'll directly apply now simply 18%. Let's take 18% of 43,000. I'm getting 77. I'm just writing it 7740. So here comes the answer of your allowances. 1 lakh minus the balancing charge. Actually, balancing charge reduces your capital allowance. So I'm getting 97,740. Again, we have to just write. So let me repeat. The machine, the asset against which previously you have taken the super deduction, then entire disposal proceed will be equal to balancing charge. What is the corporation tax payable by DOF Limited for the period ended March 2025? DOF Limited has one associated company, Crow Limited. If there is one associated company, it means in the group there are total 2 organizations. One parent is there. Associated means your subsidiary. It means there are 2 companies in the group. What is the importance of having more than one companies? Basically, we prorate the limits by using these number of companies. And has the following results for the 9 months. This is also important. Due to 9 months, we will also prorate the limits. 31st March 20. Trading profit is 40. Chargeable gain is 20. Dividend income in case of corporation tax is exempt. No matter it is coming from your subsidiary, it is not coming from your subsidiary, simply dividend income is exempt. But we know that if dividend income comes from a non-group companies, the role of that dividend income is just to take that and calculate augmented profit. Right now, this 12 will not be a part of even augmented profit. Why? 12,000 was received from Crow Limited, and Crow Limited is your subsidiary. While calculating augmented profit, we do add dividend, but that dividend is a dividend which is coming from non-group companies, unconnected companies. Crow Limited is your subsidiary. So this 12,000 will not be a part of augmented profit. Simply trading profit plus chargeable gain, your taxable total profit will be 60,000. So we know that corporation tax rate is 25%. So 60,000 into 25%, I'm getting 15,000. Now we'll simply deduct the marginal relief. Upper limit of the marginal relief is 2,50,000, but this will be a portion due to in group there are two organizations, that is why 1/2. Then accounting period is your chargeable accounting period is less than 12 months, so further time apportionment. So 2,50,000 divided by 2, then 9/12. So augmented profit is 93750. This is the upper limit. Lower limit is 50,000 into 1/2, 9/12. So 50 divided by 2 becomes 25, 9/12, 18,750. So obviously you can see that what is Dove Limited? Can I say Dove Limited taxable total profit is more than the lower limit and it is less than the upper limit. So obviously margin relief is available, but augmented limit is 93750. In the question, we have augmented profit 60,000. 3/200. After that, if you recall the formula, we use taxable total profit, then augmented profit. Logically, in this question, they both are equal. So that is why it has no importance. 93750 minus 60,000, 3/200. I'm getting 506. So 15,000 minus 506 gives us a corporation tax liability 14,494. Your corporation tax liability is 14,494. What is the amount of input VAT recoverable by Shelia in a quarter ended March 25 in respect of entertaining office equipment and car? Shelia is registered for VAT. For the quarter ended March 25, the input incurred on her purchases and expenses include the following. Entertaining overseas customers. If you're entertaining overseas customers, input VAT is recoverable. Purchase of new office equipment, of course, it is recoverable. Purchase of a new car for the business and a private use by one of Shelia's employees. When you are buying a car and that car is having a private use, no matter it is in the private use of an employee. So the rule says, HMRC says, if you have a car in the business which has a private use, then input VAT is not recoverable. Input VAT relating to the car is only recoverable when the car is 100% used in the business. So here it is not the case. So simply recoverable input will be 620 plus 1550. 620 plus 1550. I'm getting 2170. What amount of VAT is payable by Destiny to HMRC in respect of the year ended March 2025? Destiny is registered for VAT and calculates her VAT liability based on a flat rate scheme. The relevant flat rate percentage for Destiny is 12% for the year ended. Destiny sale exclusive of VAT. Basically, when it's a flat rate scheme, what you have to do, number one, you have to take all of your supplies, make them inclusive of VAT, then simply apply 12%. Whatever comes, that will be your VAT payable. They've given us VAT exclusive values, standard rated sales. How will you make it VAT inclusive? Simply add 20% into that. So just multiply this with 1.2. 45,000 into 1.2, VAT inclusive value becomes 54,000. Zero rated 25,000 will remain 25 because it is zero rated. So obviously, if you take 0% of 25,000, so it will be zero. So 25 will remain 25. Even I have to take the exempt sales as well, as it is 8,000. Logically, we cannot 25 will remain 25 even you go for a gross up, because zero rated means your VAT rate is 0%. On exempt supplies, actually, we do not apply any VAT. So that is why 8,000 will remain 8. So here becomes your total sales, standard, zero rated and exempts, and VAT inclusive. I'm getting 87,000. So simply 12% of that will be your VAT payable. I'm getting 10,440. Only the standard rated supplies you will have to add 20%. Otherwise, zero rated will remain same. Whatever the value is, when you're going to make it VAT inclusive, it will remain same. Exempt supplies, sales amount will remain also same. Only standard rated, you have to add 20%, and then obviously VAT inclusive value will be higher than VAT exclusive value. But in case of zero rated and exempt sales, you can say that VAT exclusive and inclusive, both in both the case, the value will be same. What is the gross capital gain tax payable in the tax year 24-25? Richard acquired a holiday villa for 1,25,000. On 1st May 14, he gave it to his wife Rose on 30th September 19. Actually, transfer between husband and wife, or wife and husband. Actually, the transfer has no gain, no loss. Logically, cost of that asset, which was for the first spouse, becomes cost for the second one. When it was worth 1 lakh, this is not important. Rose sold the villa for 175 in July 2025. Disposal proceed is 175. We will deduct the original cost, which is 125. Chargeable gain is 50. Rose had no other disposal during the tax year. It means annual exempt amount is available, which is 3,000. And capital, we have got capital losses brought forward 11,000. Brought forward. Here comes the taxable gain. 50,000 minus 3,000 minus 11. I'm getting 36,000. Okay. But this is not the answer. We need to calculate Rose capital gain tax payable. Okay. Her taxable income for the tax year 24-25 is 30,000. We know that dividend income is tax. Capital gain is actually tax at the end of all other sources of income. And we are selling holiday villa. Okay. Basic rate band is 37,700. Already there's a taxable income 30,000. It means still there's a space of 7,700. So on this 7,700, applicable rate is going to be 18%. Then, because when you are selling a residential property, there's a space in the basic rate band, it is 18, otherwise 24. Other than residential property and all other assets, there's a space in the basic rate band, then applicable CGT rate is 10, otherwise 20. So 36,000 minus 7,700 into 24%. 7,700 into 18, I'm getting 1,386. So 36,000 minus 7,700 into 24. 6,792. I'm getting 8,178. Let's see the option. We don't have any option. 8,178. Brandon bought 30 hectares of land on 1st March 17 for 3 lakh. How many? 30. Okay. On 1st March 19, he sold 10 hectares of land for 150. At this time, the remaining land had a value of 250. So it's a part disposal scenario. On January 25, Brendan sold the remaining hectares. Okay. Before the remaining hectares, first, he sold how many hectares? 10 hectares. Okay. Allowable cost of 10 hectares. 300,000. He sold 10 hectares of the land for 150. Sale proceed divided by sale proceed plus market value of the remaining land. So 150 divided by 4 lakh and then into 300,000. So basically the way back when 10 hectares were sold, so allowable cost relating to the 10 hectare was this. Now allowable cost for 20 hectares. 20 hectares. Simply we'll take 300,000 minus 112,500. Let's see. Students, I'm getting 1,87,500. Disposal proceed of remaining land is 4,25,600. So allowable cost. So here comes the chargeable gain. 2,38,100. Obviously, the chargeable gain is 2,38,100. Due date. Now this is important. It's a part disposal scenario. And normally, when do we pay CGT? We pay CGT on 31st January after the end of the tax year. We normally, other than residential properties, we know that in case of residential properties, you need to pay CGT within 60 days of the disposal. Other than that, normal due date for the CGT is 31st January after the end of the tax year. So it means for a disposal in 2024-25, CGT payment date is going to be 31st January after the end of the tax year. So that is going to be this. So can I say logically option D? Logical choice is option D. How much inheritance tax is due on the lifetime gift as a result of Bruce's death? Bruce died on 16 July 2024. He made one lifetime gift on 10th November 19 into a discretionary trust. If you count the time period from 19 till here, he died within 7 years. He paid the lifetime tax 52,250 and gross chargeable transfer was this. 5,86,250 simply nil rate band. 3,25,000. Let me use the calculator. 5,86,250 minus 325. I'm getting 2,61,250. IST, of course, at 40%. Let's take 40% of this. I'm getting 1,04,500. Okay, now. He made the gift on 10th November 19. He died on 16 July 24. Let's count the time period. It's going to be 20, then 21, 22, 23, 24. It is coming between 4 to 5. And when death is within 4 to 5, taper relief is 40%. Again, taper relief table will be given to you in exam. %40. Let's take 40% of this, which is 41,800. And during the lifetime, he has also paid 52,250. IST paid in lifetime. How much? 52,250. Here comes the IST payable on death. 1,04,500 minus the taper relief minus the tax which was paid during lifetime. Students, I'm getting 10,450. Is still the amount of IST which is going to be paid. It is actually 10,000 to 450. Let's see. Great. Brian died on 11 December 2024 and left an estate worth 1.276 million to his daughter. Brian main residence, value at 3 lakh, main residence, okay, was included in the total value of the estate, and Brian made a transfer to his sister 220. Left an estate worth 1.276 to his daughter. Direct descendant. When there's a main residence, and it is left to the direct descendant, means children and the grandchildren, then in addition to the normal nil rate band, that individual also gets residential nil rate band of 1,75,000. Okay. Death estate is 1.276 million. Normal nil rate band is 325. But let's count the time period. And we are calculating IST on death estate. Number one, you will not be getting any taper relief when you are calculating IST on death estate. Second, we have to count the time period from the death. If you go back from 11 December 2024, so you will see within 7 years from the death, Brian made a transfer to his sister. We know that when you made a transfer to your sister during lifetime, 220 was pat. But since Brian died within 7 years of making transfer to his sister, so this amount actually becomes chargeable on death, which means that during lifetime, we know that 220 minus annual exempt amount of the current year and the previous year. So 220 minus 6, just a minute, 2,14,000. So basically, during the lifetime, you can say that PAD was 2,14,000, but due to death of Brian within 7 years of making this gift, entire 2,14,000 becomes chargeable. And this 2,14,000 will actually utilize your nil rate band. 3,25,000 minus 14, remaining nil rate band is this. Now, since it can be seen in the question, Brian main residence value is 3 lakh. Examiner is highlighting that calculate IST on death estate, and examiner is highlighting the main residence, which is left to direct descendant. So you will be getting residence nil rate band 1,75,000 also. So let's see the taxable estate 1,276,000 minus 1,110,000 minus 175. I'm getting taxable estate 9,90,000. Obviously, applicable rate is 40%. I'm getting 3,96,000. I'm getting IST on death estate. I'm getting is 3,96,000. Let's see. No. Okay. Which of the following statements concerning self-assessment tax return for individual is true? Individual with tax payable of less than 1,000 for tax year are not required to file a tax return. False. You have to. Individuals are only required to file a tax return for the tax year if they receive the notice from HMRC. False. What about those people that are still submitting, not getting the notice? All individuals who submit tax return on time are able to have their tax payable calculated by HMRC. So this is possible. If you're submitting your tax return on time, then you can simply ask HMRC. You can request HMRC to calculate income tax for you. They will do it. The tax return for an individual covers income tax, class 1 and 4 NIC contribution and capital gain tax liabilities. It says your tax return for individual covers your income tax. It covers class 1, class 4 NIC. It covers contribute insurance contribution and what? NIC insurance contribution, capital gain tax liabilities. Students, if you just recall, if I'm paying, for example, if there's a CGT on residential properties, then actually I will be paying tax in advance on that. So tax return will not only cover this. What about if there are any other income, for example, pension income? Okay. So basically, only the logical answer is C. For the tax year 23-24, Kia filed a paper self-assessment tax return on 10th August 2024. What is the deadline for Kia to make an amendment to his tax return for the tax year 23-24? Actually, you can amend the return within 12 months from the filing date, within 12 months. Okay. And by what date will HMRC and by what date will HMRC have to notify Kia if they intended to carry out compliance check into his tax return? So let's see. Select the appropriate box for the table below. First of all, you need to know the rule that taxpayer can amend the return within 12 months of 31st January of from the filing date. And amendment, therefore, compliance check, I would say within 12 months. So number one, 31st January 2026. So compliance check should be 10th August 2025. It should be B. But for that, I would say student, once you should be going through the self-assessment chapter also. What payment on account will Gilbert have to make on 31st July 25 in respect of his tax liability for the tax year 24-25? Student, tax year 2024-25, your first payment on account is on 31st January during the tax year. Then second payment on account is on 31st July after the end of the tax year. They are asking us this one. And how much will you pay? It depends on the tax year 23-24. Relevant amount. We'll take 50% of the relevant amount. 50% of tax year 23-24 will take the relevant amount from the, I'll take income tax plus class 4 NIC minus pay. I'll get the relevant amount. 50% of that will be paid on first payment on account and then second. Let's see. 23-24 income tax payable is 300, class 4 NIC is 320. Actually, this is capital gain. It does not come in. Your capital gain tax liability will not be a part of a relevant amount. So if you add 300 and 320, logically your relevant amount is not exceeding 1000. If your relevant amount is not exceeding 1000, you are not required to pay payment on accounts. So repeat, your relevant amount is not exceeding 1000 pound. Capital gain is not a part of relevant amount. Capital gain tax liability is not a part of relevant amount. So right now, income tax and class 4 NIC, they're not exceeding 1000. They're combined not exceeding 1000. That is why there's no payment on account. Okay. Okay, students, just read it quickly. Which of the following statement is true concerning IST exemption for lifetime transfers? If potentially exempt transfer and chargeable lifetime transfer are made within the same tax year, an annual exemption will always be applied to CLT. This is because unlike CLT, PAT may never become chargeable. False. PAT can also become chargeable if the death is within 7 years of making PAT. Plus, we have to see the date. We always deal with the question in a chronological order. If PAT is first, so obviously I'll be using the annual exemption against the PAT. So one is false. The small gift exemption applies to transfer to both individual and trust. False. It's only for individuals. A gift in consideration of marriage from an individual's parent sibling is exempt to amount 1000 pound. True. And a student marriage exemption, you need to memorize it. Transfer of individual saving account, premium bonds are exempt for no. You should be saying CGT, not IST. What is the total amount of IST exemptions that can be deducted from the transfer from Thomas to his niece on 12th April 17? Let's read Thomas. Thomas died on this date. Before his death, Thomas made 2 gifts during his life. On 12th April 17, he gave a gift to his niece for a marriage, 9,000. He also, okay, now let's, marriage, this is 12th April 17. Then second gift was on 2nd September 17. Now listen. Gift was made on 12th April 2017. So first of all, current year annual exempt amount of 3,000. Then brought forward annual exempt amount, unused annual exempt amount of the previous tax year, plus marriage exemption of 1,000 pound in case of niece. So maximum he can deduct, Thomas can deduct is 7,000. 2 annual exemptions, current year and the one previous year, and 1,000 is the marriage exemption. How much lifetime IST was payable on the gift to trust on 2nd September 17? 2nd September 17, he also made a transfer to a trust 4 lakh. Of course, annual exemption is already utilized and there's no other gift. So 4 lakh. Simply minus the nil rate band 3,25,000. Taxable amount is 75. Let's see. He also made a transfer to a trust and paid lifetime tax. Can I say when donor pays IST during lifetime, then IST rate is 25%. When donor pays lifetime IST, then during his lifetime, then IST rate is 25%. I'm getting 18,750. When donor pays IST during the lifetime, then it is 25%. And nothing is mentioned, again, donor will pay. If donor pays, then it is 20%. What is the nil rate band available when calculating IST on Thomas death estate? What is the total nil rate band available? Okay. His wife Sarah died on June 2008. Her unused nil rate band was 62,400 and was therefore available to claim by Thomas' personal representative after his death. Very important point. If one spouse is died before the second one and the first spouse did not utilize the entire nil rate band, then it will be transferred. Unutilized nil rate band will be transferred to the surviving spouse, but according to the percentage. June 8, actually, it is a tax year 0809. At that time, nil rate band was 312. 62,400 divided by 3 lakh. So let's see what is the percentage of unused nil rate band. I'm getting 20%. So Thomas will be getting 20% in addition to the normal nil rate band. Let's see what else is given here. At death, Thomas' estate was worth 1.6 million. This comprised cash worth 5 lakh, ISA worth 50,000, premium bonds worth 250, a house worth 3 lakh with a mortgage on it 60,000, shares worth 3 lakh, chattel and the chattel as the remainder. The whole estate was left to his son. Okay, now listen. Normal nil rate band is 3,25,000. Add unused because of the first spouse, I'll take 20% of this. 3,25,000, take 20% of this, 65. I'm getting 390. I have a question, students, please reply. My question is why we are not considering residence nil rate band. My question is why we are not considering residence nil rate band, even though entire estate is left to for his son and son comes in direct descendant. Direct descendant means children and the grandchildren. So my question is why we did not consider here residence nil rate band. Student, please listen the answer carefully. It is mentioned in your study text that regarding number one, of course, in the death estate, there has to be the main residence left for the direct descendants. Plus, if it is mentioned in the question that residence nil rate band is available, then you will be thinking for the residence nil rate band. If nothing is mentioned, you will not go for a residence nil rate band. So since nothing was highlighted here regarding residence nil rate band, so we did not go for that. And you can see the choices also. Even you go for that, you won't be able to get even any answer out of these four. But it is mentioned in the Kaplan book that in taxation, if residence nil rate band is available, then it will be mentioned in the question. Okay. What is the total available? Now look at this. Residence nil rate band when calculating the IST on Thom's death estate if the relevant election is made. Now they are specifically asking the residence nil rate band. Now come here. His wife Sarah died on this. Her unused nil rate band was this. Now listen carefully. Nil rate band, because of the wife, he will get 1,75,000. His own residence nil rate band is his own residence nil rate band is there also. 175. If you add both of them, 1,75,000 and 350, we have to compare this with the main residence value. House worth is 3 lakh, but on this we have a mortgage of 60. So we will deduct that mortgage. Now, whichever is lower, that is main residence minus mortgage, the value is 240. We'll compare this 240 with 350. Whichever is lower is going to be your residence nil rate band. Of course, residence nil rate band cannot exceed the main residence value. And how do we determine the value? Whatever is the value, we do deduct the mortgage. Okay, students, this is now another question. What is the net chargeable gain on the disposal of Williams sole trader business on 30th June 2024 that qualifies for business for better? What is the net chargeable gain on the disposal of Williams sole trader business on 30th June 24 that qualifies for better? Let's see. On 30th June 2024, Williams sold a business that he had run as a sole trader since 1st January 2020. He realized the following gains and losses on the chargeable asset of the business. Chargeable means they have resulted in capital gain or loss. So simply 60 plus 64 minus 30. I'm getting 1,11,000. What is the net chargeable gain disposal of Williams sole trader? So net chargeable gain is this. What is the allowable cost? Allowable cost used in the capital gain tax disposal computation for the sale of 2 hectares of land by William on 3rd August 2024. What is the allowable cost used in the capital gains tax disposal computation for the sale of the 2 hectares of land? Let's see. It's here. On 3rd August 2024, William sold 2 hectares of land for 92,000. William's father had originally purchased 3 hectares of land on 4 August 11 for 19,500. His father died on 17 June 2029 and the land was inherited by William. On that date, 3 hectares of the land were valued 28,600. Basically, for William, the value of 3 hectares is 28,600. Inherited court value, you can say that there's another term which we use, probate value. So when you are getting an asset due to inheritance, at that time, whatever is the value, that is the value for William, which is 28,600. On 1st December 19, William incurred legal fee of 500 defending his title to the 3 hectares of land. When you are bearing any legal fee to protect the title of a non-current asset, so that 500, then such a legal fee is also a capital expenditure. It means that 28,600 plus the legal fee. So entire cost of 3 hectares for William is 29,100. The market value of the unsold hectare of the land is this. So here comes the allowable. We are required to calculate allowable cost of 2 hectares. This part disposal formula. 2 hectares are sold for 92. Market value of the remaining hectare. Let's see. 92 plus 38. Logically, in the denominator, we are having 1,30,000. So 29,100 multiplied by 92,000. The total of these two is 130. divided by 1 lakh 30,000. Students, I'm getting 2 lakh or 20,594. Okay. What is the amount of private residence relief available on the disposal of house by William? William sold a house for 840, which had owned individually. The house had been purchased for this. Disposal proceed is 8 lakh 40. Cost is this. Here comes the chargeable gain. 840 minus 222,900. 6 lakh 17,100. And we are required to calculate what is the amount of private residence relief. Okay. We know that if ownership and occupation period is equal, then entire amount becomes exempt. Throughout the period of ownership, William and his wife Jenny occupied the house as their main residence. Wow. 1/4 of the house was always used exclusively for business purposes by the couple. Now stop. Actually, ownership period and occupation is equal, but there's one problem. Entire accommodation was not used as a house. 1/4 was actually used in the business. So logically, the relief is only 3/4. The relief is only 3/4. 617,100. 4,62,825. 1,54,275. But they're asking relief. So relief is 4,62,825. Okay. William brothers Luke has told William it would have been better to have transferred 50% ownership of house to Jenny prior to its disposal. Which two of the following statements are correct? The transfer to Jenny would have been at nil. Who's Jenny? Jenny. William sold the house. Okay, wife Jenny. Okay. We know that if there's a transfer between husband and wife, it is at no gain, no loss. True. Private residence relief available would not have been available in relation to the gain. That's false. The amount of the gain that would have been saved this for either it is C or D, we have to do the calculation. Now let's come here. William is a higher rate taxpayer. William is a higher rate taxpayer. And 3,000 they have already utilized. Now listen, come here. Basically, if William does not transfer half of this, then William will have to pay 24% because William is a higher rate taxpayer. You will have to pay 24%, which is if William is not transferring half of this, then William will have to pay CGT 37,026. If William gives half of this to Jenny, let's see Jenny's taxable status. Jenny had taxable income 21,440, had made chargeable gains. So Jenny does have a space in basic rate bank. Now let's see. Instead of this, if 154,275, 50/50. You can just make one difference very easily. Let me give you the shortcut. Actually, in the basic rate band is 37,700 minus Jenny's taxable income is 21,440. So how much space is left? That is easier. In the basic rate band, Jenny is having 16,260. Logically, on this 16,260, Jenny will be paying 18%. When it comes to William, it is all 24%. But only the difference making is 16,260 space in the basic rate band. Instead of paying 24%, Jenny will be paying 18%. Other than this amount, everything is same. So only 16,260 on this, couple will save 6%. Why couple will save 6%? Because if you're not transferring 50% to the Jenny, then you will be paying 24% on entire gain. If you transfer 50%, then only the gain amount, which is 16,260 on this, only on this amount, 16,260, Jenny will be paying 18% instead of 24. So couple will be saving 6% only on this amount. No need to go for an entire calculation. So I'm getting actually 975.6 or make it 976. So actually couple will save 976. So William will save 976. Okay. What is the chargeable gain arising on the disposal of warehouse by Luke in December 2024, assuming all available reliefs are claimed? What is the chargeable gain arising on the disposal of the warehouse by Luke in December 24, assuming all available reliefs are claimed? Let's see. Luke. William brother Luke made the following disposal. October 13, Luke sold a factory, 230,570, made a gain. After this, he bought a warehouse. So you can see that you are buying a qualifying asset within a qualifying period. It means you have claimed the rollover relief. So 231,211 minus the gain on the factory, 31,083. Here comes the base cost. 231,211 minus 31,083. I'm getting 2,128. He sold the warehouse. Now you are selling the warehouse for 270,213. So here comes the gain. 270,213. So I'm getting a capital gain 70,085. And this is what they are asking. What is the chargeable gain? They're not asking the taxable gain. On the disposal of the warehouse by Luke in December 24, assuming all available reliefs are claimed. So this is the only rollover relief was available. So, and it is mentioned in the question that you should assume all the reliefs were claimed. So by considering that, your chargeable gain will be 70,085. So I strongly believe this should not be a problem at all. Let's see. Now what do we have? Okay. What penalties will Kilimanjaro Limited be liable for the late 31st March 25 VAT returns? Student, if you recall, logically what happens? One penalty point is incurred each time if you are submitting the quarterly return late. And when do we pay the penalty of 200 pounds? Actually, penalty of 200 pounds is paid when there are 4 penalty points. You will not be paying the 200 penalty until you reach 4 penalty points. Let's see. On 1st of August 2022, Kilimanjaro Limited registered for VAT. Annual turnover is always in excess of 150. The most recent VAT have been submitted as follows. 31st March 25. Okay, 31st March, this 29 days late. This was on time, 10 days late. So, okay. Then 31st December, it is on time. Then we have got, so actually, only 3 times late. Can I say a third penalty point? Actually, 200 penalty, 200 pound only applies when there are 4 penalty points. Right now, they have just reached 3 penalty points. Wow. But they are on the way to get 4th also, the way they are running the business. Click on the relevant boxes below to identify the late payment penalties that will have to arise on 31st March 24 and 30th September 24. Okay, now let's see. VAT paid in the bracket, negative shows refundable, 31st March. Now look at this. How many days late? 29 days late. Actually, 2% applies when you are late between 16 to 30 days. Even though this here, they are 29 days late, but still there's no, I would say, penalty at all. Why? Because 3335 is VAT refundable. It is not VAT payable. So click on the relevant box below, identify the late payment penalties. So here actually late payment penalty is 0. Why the late payment penalty is 0? This is the question. The answer is because there is no VAT payable, this VAT refundable. So why would I pay penalty on VAT refundable even though I submitted the VAT return 29 days late? Normally what happens if you're submitting within 15 days, it's okay, no penalty at all. When you're submitting between 16 to 30 days, then you have to pay 2%. If you're going for more than 30 days, then you will have to pay 4% plus a daily penalty will apply. But the point is, it is everything is applicable when it is VAT payable. So March 24 is VAT refundable, no penalty. Then they're asking September 24. September 24, just 10 days late. Again, no penalty. Why? When you are submitting within 15 days, no penalty. So logic, there are 2 different reasons why March 24 there is no penalty, because it was VAT refundable. That's why no penalty. On 30th September 24, why there is no penalty? Because paid within 15 days. What is the tax point for the order of goods for VAT purpose? Tax point. Let's see. Order of goods. Kilimanjaro Limited. Receive an order for goods on 20th October 2024. If you get the amount in advance, then that date becomes your tax point. It becomes actual tax point. But they have received the order, not the payment. The goods were delivered to the customer 20th December 24. This is actually your basic tax point. But if you have received the payment in advance, that becomes your actual tax point, or you issued the invoice within 14 days, then invoice date becomes your actual tax point. And Kilimanjaro Limited sent invoice 2000. Yes, you are issuing the invoice after 14 days. So logically, basic tax point, basic tax, which is 20th December. This is your tax point. Okay. How much input VAT was Kilimanjaro Limited able to recover in respect of the irrecoverable debts in its VAT return for the quarter? Okay, in case of irrecoverable debt, if from the due date, 6 months, at least 6 months should pass from the due date. If the time period is at least more than 6 months or 6 months, it exceeds 6 months, then you will be able to recover your input on irrecoverable debt. But from the due date, it should exceed at least 6 months. Let's see. March 25, Kilimanjaro Limited wrote two irrecoverable debts on VAT return. First, 800 VAT inclusive. VAT inclusive means it is, if I need to calculate VAT, then I have to multiply this with 20 upon 120. Because VAT inclusive means it has the impact of VAT. It is actually representing 120%. Was due for the payment on June 24. If you count the time period from June 24 to March 25, it's more than 6 months. So you will be able to recover input VAT on this 800. And despite being chased, still not paid. The second 1,000 VAT inclusive related to a company that Kilimanjaro Limited has recently been informed has gone into liquidation. The debt due, if you see the due date and March 25. So in case of second bad debt, can I say you cannot recover input VAT right now because time period of 6 months has not passed. But the first one, yes, it is more than 6 months. So 820 upon 120. Let's use the calculator. Students, I'm getting 133.333. So 133 is actually recoverable. Which two of the following statements are correct regarding the errors have been made? If the net error is less than 10,000, 1% of it has to be 50,000, not 60. So that is why the first is false. So we are left with 3. Error exceeding the de minimis limit must be separately notified to HMRC and custom as soon as practicable. Okay. The maximum additional penalty that can arise as a result of error is VAT loss due to what? So this is true. This could be your maximum penalty, not more than that. So error exceeding the de minimis limit must be separately notified to HMRC and customer as soon as practicable. So you should do it as soon as possible so that you can save yourself from a larger penalty. As the company has not attempted to conceal the error, has apparently made voluntary unprompted disclosure, the penalty will not exceed 20% of the lost and waive amount. It is not 20, it is actually 30. So 20 is incorrect. So this is also false. So dear students, that was all about September 25 pre-scene mock section A and B. Section C, we are going to discuss on coming Friday, inshallah. But the video lecture of section C will not be uploaded. We have already uploaded the first session, and this session will be uploaded also on the YouTube. Of course, those students, they are enrolled, they will get the recording of section C as well. Plus one more thing I said previously also. In the entire Kaplan kit, if there are any questions, long, short, multiple choice, section A, B, whatever it is, you can share those questions with me. We can discuss them during the live class as well. So, but you can see that within a very limited period of time, we have discussed the section A and B. So hope to see you all and others in a coming live revision class on Friday. And that is going to be the last live revision class, because what will be the date on Friday? What will be the date on Friday? Thank you. I think if you check the date on Friday. So it will be 22. So obviously coming Friday is going to be the last live revision class. Yeah, 22nd. So obviously after that it will be 2. After that, still my WhatsApp support will be available. No issue at all. So, okay, students, hope to see you all and others in the coming live revision class. Thank you.